Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at Trade Station. It's great to be with everyone again. Today is Thursday, May 22nd, 2025. I'll show you a few disclosures to begin, as usual. I'm share a few things in the chat. So, recently we had talked about a potential range forming, and that's exactly what has happened. We had identified some levels, and it's interesting, the Friday of Christmas week was an important level that in some ways had kind of disappeared off our radar for a little bit, and now it's back. The closing price on the S&P 500 on December 27th, the last Friday of last year, the last weekly close of the year, is now emerged as our high. So you're going to go, first of all, to tradestation.com, and then you roll down the page a little, and there's also a link to this in the description and things of this video. Come on. No, it's not. Anyway, scroll down the page here and you'll find our blog. What is this? How annoying. It's one of those funny things that happen sometimes with your computer. So go to tradestation.com and go down the page and you're going to see a blog post that has my picture and it says, market trends. And that has a rundown of today's webinar, today's presentation. Let me just start off now by showing you some standardized returns. Just a strange thing happening there with my Chrome. I apologize for that. So these are standardized returns from key ETFs. Overall, I think the main thing that we have here, today's webinar is called, is the Sell America trade coming back, or it might be back? And I think that's one of the things we've kind of seen here with the situation with this, with the yields moving higher in the Treasury and all this debate in Congress and all that stuff. And I think the key thing here is we've really moved. If you look, we had the despair about tariffs back in, March, early April. Then we kind of shifted to an optimism, everything was going to get better, and now we have a new crisis. And I think that at this point, there is a real risk that the Sell America trade is a new secular trend. And at the same time, it might be one of these kind of phantoms that kind of dissolves in the coming months. But I think it's important to realize when you look at secular trends overall. By the way, let's see if we can get this now. I'm going to just kill this. I don't know why it's not working. Let's just do a new Chrome in a second here. But when it comes to secular trends, there's often many drivers for them. They're not just kind of one thing. So secular trends in the market will have, um, different kinds of demand, if it's a technological trend or something like that. And if you look at this right now, we have multiple drivers for something that could be a secular trend of sell America. And I think it's important to realize that. Right now we have the whole question of tariffs. Tariffs have been reduced, but they're still going to stay higher. There's the whole question of there's too many treasuries in the world, too much US Treasury debt. And that creates issues. There's also the question of politics. There's now the United States is doing things politically that might cause some, it's ruffling feathers with Europe and other things like that. These sort of, policies we're doing are potentially, hurting our position in trade and things like that. Things like with tariffs, when you put, obviously when you put tariffs on other countries and then they react and all these things are now political risks that did not really exist for the United States for a lot of years. Then we have the fact that we have relatively high multiples compared to the rest of the world. We also have overconcentration, a period of overconcentration. Very often at the beginning of a bear market, you will actually see an overconcentration in something, and then it kind of goes from being a bubble to being, unwound. So I think all those things are true. And you could actually make an argument here that they're beginning of a more lasting sell America trade. And at the same time, if you look out, not in the next few weeks, but in the next few months, there are things that here could kind of, become more positive. And one of them right off the bat is the fact that energy continues to have bad things happening in it, and lower energy prices overall will be a positive for the United States. The other thing is that we are getting just, signs that the inflationary situation, despite whatever people say about tariffs, there are other things happening. I think that cannot be ignored with housing. I continue to say this, and at a certain point in time, we're going to get the last CPI, was strong, and these other things kind of trickle through here. And the fact is that there is a secular decline in, in inflation, and then there are other things to the tightness in the labor market that will overall support, jobs. So I think right here now it's possible for people to look out and see us entering a period of a few weeks and a few months of range bound bearishness, and that I think is out there. But I think it's also important to realize that some of these things already had kind of forces in them that we're going to be getting potentially better. So I want to just kind of emphasize that. So now let's see if we have our. Here we go. So let me actually go down here and you can see. I wonder why my blog post is not appearing. It's one of those days when my Chrome is not working right. I'll tell you, I'm off. We're off next week, so let's go over here to Market Insights, and we'll be back. Over here is the actual blog post. The Sell America trade might be back. So the overall kind of thing that stands out to me, and if you actually go back and look at the market trends we did last week, I want to just kind of emphasize this. This is the market trends from last week, and we had identified a range, and it has essentially been kind of emerging here. So when we did this, we had healthcare's historic collapse, and I'm going to get to this chart here, the S&P 500, because it might be kind of giving us the top of a range here and a potential signal. There have been some signals on our MT ES version 2 chart, our MTES chart, which gives signals on the S&P, which I'm going to get to in a second. But if you look over here a week ago, look at this range we identified, and that is very much something that is coming to play. Now, if we look on our blog post for today, this is now the range, and it's essentially what we've settled into. So it's very similar. We had outlined, some real price congestion from late February, early March. Open image in new tab. You can see we had this, essentially this big cluster of price action was what we outlined as being a range, and it essentially did morph into a range. Now, of course, that was a range because of this level that goes all the way back. This is the Friday of Christmas week, the last Friday of the year. And here you can see this range develop, and then this becomes a range over here. So overall, I think the thing that, I'm kind of, having in mind is essentially, a high roughly around 59.71, and then some kind of low potentially down to 57.86, or another one was 57.73, I believe, was a low that was in place. Let's look over here on this. Let's look over here. This is an hourly chart, but if we look back to January, this low in January was around 57.73. So this is an hourly chart of the S&P. So from my view here, you have, if you look on this, let's make this bigger. You essentially have here, um, a pretty significant level, this low that became the high in late March, around March 25th. And now that was also where we gapped up. So from my view here we are drifting in the Memorial Day, holiday week, and also not a lot of catalysts. And essentially this goes across. Now this yellow line is my rising 10-day moving average. This has a degree of importance. The one thing though is that it has been rising for a while here, and there are some other signs of momentum fading. So from my view here, I mean, when the 10-day first turns positive and you get down near it, this is where it gives signals. And I'm not saying here that this is anything that's necessarily like inherently bearish here, but from my view, this has been rising for a while now, and it's not necessarily a meaningful signal at this point in time. The signals that are potentially more interesting here, if we go over to our if we go to our this chart. Now remember, if you go to the top of the blog, just so you guys remember, actually, no, before we get to that, I want to just kind of run through all the key points. So my point is that there is that potential here when you look at the range that we've established, that we seem to have here, that we're drifting, but we have a sort of potential of the range drifting down toward this level, which is essentially the low of last week. We gapped up after Besant came home from Switzerland with the Chinese, announcement. That was the low, and I just wanted to kind of mention here that it might be a drift into this area here, and that essentially also corresponds to that level from late March, and the level from the last Friday, the Christmas Friday of last year. So anyway, wanted to just mention that was the main thing that kind of jumped out in the beginning. Now remember, next week we have Fed minutes on Wednesday, and we have NVIDIA earnings on Wednesday afternoon. And in many ways, we have nothing until then. So we kind of have, drifting here. All right, now let's look over here at some of the key points I want to kind of cover. It's interesting to me is that Wilder's RSI got kind of up near an overbought level. Now, one of the things about Wilder's RSI that I have found is that In many ways, once you go overbought or once you go oversold, in many ways, there's a desire to go back in that direction. So what do I mean by that? This is a special study we've done called RSI past, and what it does is it basically looks at if your RSI goes overbought, for example, it basically assumes that that's bullish, and it will look for revisits of that. So what this shows is it counts how many candles since the RSI went overbought or oversold. But what it shows is when you go overbought, there's a tendency to kind of go back and hit overbought multiple times. And when you hit oversold to a certain extent, like in this bear market here, once we hit that kind of oversold, there was a tendency. I mean, it did go back here to overbought, but I mean, the key thing is that once we went down and had this strong oversold condition on RSI, and now we're kind of stalling, below this bought. This might have been our high for RSI, and that might actually kind of give more of a signal that this entire downward thrust still has some relevance, and now this counter trend move might be kind of done. So this is a thing I've just noticed as well, and the fact that we had this kind of the fact that we had this strong oversold condition and now a bounce like this, it does give a certain degree of kind of, gravity, or of a kind of desire, or of a sort of, expectation of wanting to push back down somewhere deeper into these levels. It doesn't mean RSI will get oversold again. I want to just mention that, but I've noticed this to be kind of repeatedly true. And I think that if you have a sell off of this magnitude, followed by a rebound, a period of range bound is, something that historically one would look for. And I mean, unless they just come out and say we're dropping all tariffs and something like that. But I mean, that doesn't seem to be the kind of path that at this point makes a lot of sense to be expecting. Now, all right, let's look at some of the other key points I wanted to make here. Was that also, look at MT breadth. There's another one of the workspaces we share with you guys. We now see that the number of stocks above the 20-day moving average is now basically below the number of stocks above the 50-day moving average for the first time since back here. Now, we had mentioned, and this is exactly played out the way our indicators had indicated in late April. What we said was when this blue line goes jumping higher, it will create a period of benign low volatility drift. And that is what we've seen, but it has happened now. And it's been a month, and we're potentially stalling at resistance. And this might be a time when it, has largely run its course. But I want to just point out, if you go back and look at this time, we talked about how when this has this surge to the upside, that it would likely produce a period of calm and of, individual stocks outperforming and things like that. And that's what we've seen. We've seen the VIX and all those things come down, and that's exactly what this indicator gave us. But now that this is below the red line, it kind of says that that actual thrust or that condition is no longer as true as it was. Now remember, this is a number of stocks above the 20-day moving average in the S&P 500. The red line is a number of stocks above the 50-day moving average. It's a form of breadth analysis, and it's something that we have discussed with you guys at different times. So this is one of the indicators. Remember here, if you go to the top up here of the blog and you go to check out our downloads here, that's a zip file. In the zip file is a series of indicators, a series of ELD files. And if you load those into your TradeStation platform, then you can launch the workspaces. This uses a series of custom indicators. Actually, this one does not, but all the other ones do. These are just some advanced sort of things with advanced decline lines and things like this. All right, so now we're going to kind of continue here. Something else I want to mention very quickly, go to MT main, we go to our key ETFs. One of the things we can actually see is that we have actually developed a little bit in the last week or two. We've developed a little bit of outperformance in the safe havens like healthcare. I mean, it's interesting, healthcare rebounding after the carnage in United Health and consumer staples. There was a little bit of strength in utilities, but now that's taking a hit today because of the solar energy news and the higher yields. But if you look here at things like the kind of financials and tech and stuff, they've kind of showing signs of losing leadership here. Now, it's not overall decisive, but this is also something that does give a degree of suggestion that there is, some other kind of weakness forming. I think it's a bigger question of what your time frames are. If you actually have a, more of a negative long-term time frame, then this is a spot where it could be kind of reasserting itself. So regardless, I did want to mention here that we are getting a few signs here of fatigue at the sector level, at the thing with the 20-day moving average, that sort of thing. The fact that we do have a discernible range. If we look over here also on the daily chart of the S&P 500, what we see is, and I mentioned this at the time, well, we did our webinar on Monday. We did State of the Market on Monday when we look at the main indexes and things like this, and we mentioned it at the time. We said on Monday that we had an outside day. Now, it might have been a bullish outside day, but in many ways, that doesn't matter because it's a reversal pattern. And when it occurs at a range, it tells you it's the outside day, then the inside day, and then this essential the follow through to the downside here. So that was an important thing that we had also kind of indicated at the time. Also, that the drop below the 8-day exponential moving average. So um, these are just some things kind of giving a sense that the overall kind of momentum has gotten less positive in the near term now. Also, want to show you this thing that I thought was kind of interesting we did over here in Trading View. We do these ideas on Trading View, and one of them today was essentially something to look at the long-term relationship between the S&P 500 and gold. And I think it's interesting just to kind of see here that in many ways, I think it can be argued that we are in more of a true. This is a kind of another indication of sell America, which is essentially S&P 500 against gold, and you can see that essentially it has been kind of peaked out here. you know, this was a peak all the way back in 2000 and has made lower highs since then. So it's just something to kind of look at and to realize that in many ways you could argue that the real high in stocks was there, long term, versus other assets. So I think it's interesting that the stock market, would lead something like this. But I want to just kind of show you this kind of this is a monthly chart. It's a long-term sort of pattern, but this might actually also suggest here that we are in a spot where it kind of confirms this idea of an overall kind of sell America trade, and it kind of move to gold and away from U.S. assets and stuff like that. Oops. All right. Now, the other thing is, these are just some other points of the VIX being back above 20, this kind of, pressure in treasury yields and the dollar index kind of pushing lower. So it's interesting to me to see that the dollar index here, if we look on, let's look at, one of these trading view charts of the dollar index, but, essentially it has remained in a downtrend, and it's trying to hold on to a level from over a year ago. But again, this is an important indicator watch. Here's this actual chart. Let's look here at the dollar index. We'll do a weekly chart of the dollar index, but you can essentially see here. I'm going to change this back to candlesticks. But see, this is an important sort of area that I'm watching on the weekly chart. There was this kind of little trend breakout here. And I think now we have to see, do we hold this sort of area? It's a similar sort of question with things like the treasury yields. Um, we've been kind of watching here, this sort of breakout. And I mean, the fact is, this sort of high basing pattern, gives some upward pressure. Now, we had looked between 460 and 465 as an area where it was showing signs of stopping. But as I look at the overall universe of news that we have right now, and the overall kind of sense of the fiscal situation, and other things like that, I mean, I think we have to realize that this is a long-term trend, and all the news we're getting does kind of confirm that there's upside in treasury yields and downside in treasury price. When we look at the supply that's coming, when we look at things, like the, you know, the overall decline of American, credit quality, all those sort of things here point in a direction of yields moving higher. And I think that this is just something that when you look at this, and then you also look at the dollar, and you look at the other thing I just showed you with with gold, the S&P versus gold. I mean, at this point, a big move. It's happened. It's moved in one way, but the trend seems to be pointing, still in that direction, and there isn't any really clear sign, pointing any other way. So I think at this point, I think it's I want to just kind of emphasize that, and it doesn't mean that this is going to necessarily exert itself right away. At the same time, I think we also have to realize we have the events next week, which could actually be the sort of trigger for it. It has kind of played out, and I want to just kind of emphasize the fact that a lot of these forces remain in play. We're kind of consolidating here, and but there is not a lot of sense that this kind of sell America trade, kind of having ended. We could see the dollar index base here and then have some kind of recovery, or this might simply be a period of a degree of consolidation followed by a more significant and meaningful decline, which could be, more bearish. All right. So as we look out here, I thought it was interesting. There's a lot of things that all kind of tie into this. We had all these issues with the Treasury yield sitting these high levels. We had also interesting that Japan, which has always kind of led the United States, this basically Japan saw its yields go to this high, go to a 25-year high as well. Japan, what I mean is led the United States in terms of interest rates. They had their interest rates go significantly lower first, and now we've seen the other side of it. There's a certain note here from UBS with volatility, and basically saying we expect volatility as Wall Street demands confirmation of trade deals. So basically, at this point in time, people are going to say we actually want to see trade deals. We're concerned about tariffs coming through. Now, there was actually an interesting thing that Trump apparently said when he was in the Middle East. He apparently said, we're not trying to negotiate any more trade deals. I thought it was very strange it didn't get more pickup, but he seemed to have said that. Overall, it was interesting to see the sort of negativity from Jensen Huang, which I think is a little bit concerning before the event of earnings next week. It's also interesting that today we had a decent earnings report from Advanced Micro Devices, ADI, and basically they sold the news on it. So we do have a little bit of a thing here where I think we also have to realize is that basically all of this Middle East news that drove up Nvidia and the chips and all of that, it was kind of an unexpected gift. Nobody really expected, I think, to suddenly see data center deals in the Middle East and everything like that was so high profile. So there is a risk here that essentially the news that we already got, has basically stolen the thunder or front ran the news that we're going to get from earnings next week. So I think at this point we also at a spot where there's a lot of good news priced in, and it's really not very pointing, it's really not very conclusive one way or the other. It's also interesting to see this big bearish outside day that completely engulfed this multiple, more than a week of price action. So this candlestick might be one that comes back and haunts us. There are other, Nvidia has a history of forming these big ugly candles that become problematic over time. Look at some of these big candles we had back in January. Guy Adami on CNBC, I've seen him talk about it some with Nvidia having these big ugly reversal candles that then come back days and weeks later to cause selling pressure. Also, now, what's interesting is OPEC. So there's an article in Reuters that basically said OPEC is trying to crush American shale producers, and that's an interesting perspective that I think is something that it hadn't, it was not my original initial read on it. I thought that this was more of a question of internal issues with OPEC, of there being pressure inside of OPEC, to either deal with overproduction in Kazakhstan, which was some of the things I had read in multiple places, or another argument that some people were making was that essentially there was a pressure inside of OPEC Plus of people who were, wanting to increase production going all the way back to the pandemic, and the internal political forces pushed it that direction. But now I'm seeing there's other reports now basically saying that OPEC is trying to shut down American shale production, and they're going to do it by driving crude into the dirt. And I think that's an important sort of point, because that is what happened about 10 years ago when oil crashed. Now, another thing that's interesting today is there's another article today on energies. This one coming from Bloomberg that said they might increase production even more, which would be consistent with this idea. So again, when we look out into the future, that is not necessarily going to be a negative. That's actually something that could be a degree of a positive, bringing down inflation. So there are things out here that, as you look out, they're not really confirming the negativity. We have these negative comments of people like Jamie Dimon and Richard Bernstein that were kind of interesting. So those were like kind of the main things I think kind of highlighted. Now let's take a look back over on the platform, because what we started off with was this is our MTES. Now, if we look at this, um, this is the chart that sometimes they give trading signals, and basically I thought was very interesting was it looks for the direction of the 50-hour moving average, which is this line here. Now, if you notice back on the 19th, it actually went down and it was green, and stochastics went oversold. Now that was a buy signal. And then if you look essentially over here, at this moment it was actually rising slightly, but we had basically moved under the 50-hour, and stochastics basically went overbought, and that was a sell signal. And now we're in a spot where the 50-hour is falling and stochastics are getting back overbought. We also have this low from back here on the 19th that we're sitting below. So my perspective here is let's kind of see what happens here. If we stay under this low, it might actually result in some more sort of weakness into the close of the week. And that's kind of what I'm watching here as I look at this to see if we kind of get stuck under here, if the old support becomes new resistance, the 50-hour falling, the fact that we've basically gotten under that 8-day exponential, and the RSI has potentially peaked. So now my sense is, let's see. Now remember, this is the futures chart, but then if we move back over this, the nice thing about this workspace, it has futures, and then also has the it also has the cash index, which is here. And if that were the case, then again, the level that would be potentially interesting here would be this kind of level around 57.80, back under 5,800, down to 57.80, 57.73, which is this high from late May. So that's late March, the 25th of March. That's kind of just what I'm watching here, seeing if this kind of maps out. There are a lot of individual companies moving here, like the quantum computing stocks and some of these other names, some of these new AI stocks that recently had IPOs and stuff. We normally don't get into that too much because a lot of these, by the time we actually get to the webinar, things have already kind of happened. But I want to just kind of point out that this is that sort of stock pickers market, and we can drift in something like this. And this is exactly the sort of environment that we had discussed as a possibility going into this period of time, which is into Memorial Day. So I think that's just an important thing to mention. We had exactly talked about this sort of happening, of getting into a range, having a drift. But one of the things that's entirely possible as we near the end of the week going to Memorial Day is that you might get into a situation where the market drifts and drifts, and then towards the end of the week, if it's it could encounter potentially some weaknesses. People don't want to be long through the long holiday weekend. So I want to just kind of mention that. Now, there were just one or two other individual stocks here that I thought were kind of interesting that I did want to mention. One of them was Snowflake. There was a lot of positive sort of notes on this, and it was essentially a strong earnings report, and then there was this kind of ongoing sense that they have that they're using a lot of incremental AI kind of offerings to offer some potential gains and things, incremental AI gains essentially in terms of their products, and they're also continuing just to grow in their core market. So I thought this was kind of an interesting thing of something like Snowflake, because we are seeing these individual names, and we talked about things like Okta and stuff that I just thought were, these are names that at this point Okta reports earnings next week, so there might not be much opportunity. But the fact is that you get these names, look at the earnings report, and then now this was the whole market crashing. But now what happens if Snowflake, maybe say the market does kind of weaken in the next few weeks or something like that? Does Snowflake basically chop around, go up a little more, and then chop around 190? That's the sort of thing I think that's kind of interesting. So remember, we have over here on our MA tools is one of the tabs on the workspace that we share with you guys. We have over on MA tools things like the EMA test, so you can actually see when something will pull back. So one day, if Snowflake comes down and touches its 8-day exponential or touches its 21-day exponential, this tool over in Radar Screen would enable it. So I think it's interesting here where if we are going to get some more kind of weakness in the market, it would be interesting to actually take some of these names that have been really moving recently, put them into something like MA test, and see if they start lighting up moving averages. But for me here at this point in time, I think we have to kind of realize that this is now kind of a doldrum sort of market. We're not going to be doing any webinars next week. We have this kind of holiday drift here. And there is evidence, like I said, of this sort of overall secular shift of, of sell America, buying gold, overseas assets. It does seem to be established on a secular basis. There are multiple drivers for it. The fact that people have been over concentrated in the US, the fact that there's a lot of debt coming, all those sort of issues, the fact that we now have a less friendly and positive policy environment, all those things, kind of point in that direction. But then at the same time, we have to realize is that there are other forces that are beneath the surface, things like a strong employment market, things like the fact that there is a secular decline in inflation, regardless of what people say about tariffs. And right now we're in a spot where the cyclical sort of parts of the market, the cyclical consumer parts of the market have weakness, but the enterprise parts of the market, things like data centers and all those things, a lot of the industrials, they continue to have signs of strength. And in many ways, those are less impacted by tariffs. So we are seeing a pattern here of the consumer part, the consumer risk on being weak, but the enterprise risk on remaining healthy. And I think that's kind of the pattern that we have for now. So it's great to see everyone and talk to you. Hope you have a great Memorial Day. We will be back. Our next webinar is going to be, I believe, June 9th is the Monday after Memorial Day. We'll be back with State of the Market then. Hope everyone has a great weekend, and I'll see you in week and a half.